Okay, next up, business owners. This one's for you. If you're not a business owner, you might not care about this one. I can't stress how important it is to know your numbers. So I have a business owner client. He owns a gym and he's a PT and he wants to acquire another gym. And I asked him some basic questions of his basic numbers, of which he doesn't know. He doesn't even know his core structure setup or even the very basic accounting words which you need to know for as a business owner. So he couldn't really articulate to me the difference between being a sole trader versus a company. Now, there's multiple different ways you can get paid as a business owner, whether it be company profits, dividends, wage, director's loan. He didn't even know how he was getting paid, which luckily for him, he's come to me because I'm going to help teach him this stuff anyway. So the first thing I'm going to focus on with him is how the banks judge business owners and the multiple different ways that you can get paid, and then how to plan and adjust his next tax return. So the good news is this guy's completed 23 to 24 tax return, which we can base off some rough drafts to grab his borrowing capacity. And I really need the borrowing capacity to unlock me, right? But if you don't know some basic numbers such as your gross amount, profit, or another word that you should also know is what your EBITDA means. If you don't know what EBITDA is, you really need to go learn it. So we've got time up our sleeve to adjust his tax return correctly with his accountant, work back and forth between accountant, broker, and me. All three of us are working in conjunction with each other to make sure we're just getting the right amount of borrowing capacity. Because this guy's in what I would call good capital position. So he owns his own home. His home is worth about $2 million with a $500,000 mortgage. And he's got $200,000 cash at the age of 43. Now, the thing that's given him a heaps amount of cash injections and a smaller mortgage is the fact that he did used to own two properties. He sold off them both because they were basically shit properties, shit locations. Something else I'm going to focus on with him is making sure that all of his debt is under the company as well. So that's a good thing for business owners. If you own a company, if you have credit cards, personal loans, car loans, any of that sort of stuff, we can really isolate the debt, meaning we can ignore those debts. One of the massive advantages for business owners. But it looks like the borrowing capacity is going to be pretty low. She's working part-time as a chiropractor on about $50K a year, the wife. And his guess is he's only made profit $50K as well per year. So the key thing that I need to focus on is lifting up borrowing capacity as much as possible. Doesn't need to be that high, about a minimum, I'd say ideally, so that $500,000 to $550,000. If we can get it up to that high, then that will mean it's enough to pull out heaps of equity so he doesn't have to use his $200K cash, even though that's going to be something we're most likely going to have to lean on. Maybe do a thing called a debt recycle, which is where we get some of that cash that he's got. Maybe it's 100 grand, maybe 150K, as minimal as possible. Chuck it on the home mortgage and then pull it back out again. So it reduces his debt on his home mortgage because their income's looking like they're so low. But that's solution mode stuff, which I'll get into on the strategy call with him in a couple of weeks. But honestly, he's got about $800,000 worth of dead money and equity sitting in the home, plus another $200,000 cash. That's $1 million worth of dead money sitting there. That's enough to buy 5 to 7 properties right now inside the top 1% suburbs, all done for him. But we're going to have to do a lot of planning on structuring his numbers on paper, much better. I've also got some accountants as well, which are very educational based. So very similar to me as a coach. I like to learn. Most accountants out there are so horrible. Literally 95% of accountants are horrible at education and explaining things. They use so many jargon words that just don't make sense to anyone. So a couple of accountants I have on my team are very much educational based. They explain the pros and the cons just like I do, and they dumb stuff down as well. And they also understand the power of leverage as well to compound that to make even more inside real estate. So it's all good to be a business owner and write off your taxes and get it down to zero, cool, but that's not going to help you build wealth. The more leverage we can make, the more money that we can make, the quicker we can pay down debts, the quicker we can replace incomes and get passive income. So I'll make a 6-month plan for him now to really focus on, and then we'll make a plan for the next 2 to 3 years and beyond from there.